all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before, guys.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first note.
This is the Capital Stack. Hey, everybody. This is David Paul, the host of the Capital Stack podcast, where I talk to founders, operators, and investors about all things value creation in startups. Today is a very special day as I am going to be interviewing my sensei, the guy who taught me everything I know in venture capital, formerly managing director of Canal Partners and now managing director of Brookstone Ventures, Todd Belfer. Todd, how are you?
Do I have to say something?
Yeah.
Thank you. Thank you. Very nice introduction. Glad to be on. I had a bet with my wife that I was never going to be invited on this podcast. So I lost the bet.
Okay. Yeah. So how much is there?
I have to clean the house for a week and do the dishes. So I don't know when that'll be, but I got to clean the house for a week and do the dishes. And I said, I'm never going on that podcast. And she goes, oh yeah, he's busy. He'll get to it. And I'm like, okay.
No faith.
Now I got to invite you on my podcast.
There's no fucking way I'm going on your podcast.
Lots of tears on my podcast.
Yeah. Not because I wouldn't want to go on your podcast, but just based on what you talk about on your podcast.
Yeah. My podcast is about relationships. It's all about personal relationships. Parents, siblings, wife, friends, business partners.
Are you really pumping your podcast on my podcast?
The laundry list.
Motherfucker's pumping his own podcast on my podcast. It's unbelievable.
Stay tuned.
Todd, tell me about yourself and tell me about your foray into the investing world specifically. Because I know you spent a little time as an operator and then you went into the investing world. And just tell me how that process started.
Graduated college, 1989, worked for a public REIT for about a minute and realized I can't work for anybody else. I can't take direction and sit still. So I just started some companies right out of the gate, right out of college, not even legal. I wasn't even legal to drink. I was like 20 years old and I started a couple companies and made a living. One was called Preferred Tax Liens, where I syndicated doctors and attorneys and bought property tax liens from the state of Arizona and earned 16% of my money and distributed 12.5% to my investors, and I kept the rest as fees. And did that for a couple years. While I was doing that, my dad and I started a payroll HR company called Employee Solutions. For those of you who've been around the Valley for a long time, it was kind of a high-flying company for a long time. Kind of went from 0 to 200 million in revenue in 5 years. Went public and got out of that company in 1996. Sold all my stock. It was public and just became an angel investor and just started investing in all types of different companies. And in the meantime, I still co-founded other companies. I co-founded Raw Sushi with my good friend Scott Kilpatrick and Rich Howland. Did Net Time Solutions with Hamid and Behan. So, not just a funding source, but also sort of coming up with the idea and creating the company as well. So really early, and did that from 1996, probably until I started Canal Partners in 2008. Just really more of a angel investor / operator at times. So, and what I found is I hated operating businesses. I was never good at it. I don't like it. I don't like managing people. I don't like hiring people. I don't like firing people. I think I'm too nice of a guy. So, and that's not my skill set. So I just, quickly realized after being an operator in probably a half dozen companies, I was an operator in a company called MD Labs, a nutritional supplement company. Employee Solutions. I had my own business at Preferred Tax Liens, and sort of in on the board level of some of the other companies. But what I definitely knew I didn't want to operate. So my goal at that point was to go out and find guys, find people that I could back and give them growth capital, build a board, try to bring some sense to the madness at an early stage. And this is way before venture capital got going. I mean, this is 98, 99, 2000, 2001. I had a couple guys trying to throw me money to start my own company. And I remember in 1999, some friends of mine gave me $1 million and they're like, here, you're going to be CEO and chairman of a new company. It's called stockbrokersclub.com. I'm like, okay, what are we going to be doing? And they're like, you're going to be like the Raging Bull, which was a big messaging board system, like the Stock Twits. You're going to be like the Stock Twits of the crazy internet bubble that's going on. So they put $1 million in the account, and I'm CEO, and I'm literally not sleeping at night because I'm like, I don't know how the hell I'm going to make this work. I don't know the model. Is it an ad model? Is it you charge a premium service? It's like the Stock Twits model of today. I didn't know how it worked. So after losing too much sleep and having so much anxiety, I'm like, okay, I'm giving you back the $1 million and I'm not doing this because I'm making me extremely uncomfortable. So then I realized my days of being a founder CEO is definitely over. That was it. That stockbrokersclub.com was the final, pin in the tail. So that was it.
So you discovered early in your, I would say professional career outside the REIT that you had a gift, and that was the ability to look at a dentist or a lawyer or a high net worth individual and get them to give you money, which I think, bar none, especially in the Phoenix area, there's no one better than you, except for maybe Jeff Pruitt. But but tell me exactly what is that? How do you get that skill? Is that something that you just felt like you were born with? Was that a skill that you had earlier in your life that transferred? How did you get that courage?
I don't think it came supernatural for me. I remember back in the preferred tax lien days going to meet with attorneys, physicians, professionals, trying to get them to give me money. Give me $50,000 to put in this syndication. And I didn't know what I was talking about. I couldn't answer 50% of the questions they asked me. I was usually drenched in sweat in the meetings. And it was uncomfortable. It was very uncomfortable. So I tried to figure out how can I get more comfortable doing this? And one of the things is just keep doing it. Just keep showing up. And the other thing was start learning your shit. Start understanding what the hell you're talking about. Right. Yeah, you just can't be a promoter. You got to understand it. So I started to learn it. I started reading all the statutes on tax liens. I went to all the auctions. I talked to all the real estate attorneys. I went and visited the properties. I talked to my neighbors at these properties that we own the tax liens on, and became pretty knowledgeable where I can talk somewhat intelligently with the investors. And fortunately for me, those deals worked out really well. We didn't lose $1 for one client back in the preferred tax liens syndications. But, it was I don't know, what's that guy's name with the public speaking guy, Zig Ziglar and all those guys. You just keep getting up there, just keep doing it. And eventually I stopped sweating, and eventually I, stopped looking down at my shoes. And eventually okay, I'm comfortable talking to you and pitching you a business or a service. And I enjoyed it. I enjoyed people. I think I just enjoy people, and I'm a social creature. I just had surgery last week, and I've been sort of tied up at my house for a week, not leaving my house. And I realize how crazy I go. I mean, I just sitting on the couch, can't leave. And I'm a people person. There's some people that love solitude, they can spend the rest of their life by themselves. I'm I'm not one of those people.
And so repetition, solves many, many things. How did you think about, when to close or when to ask for the money in relationship giving? Because sometimes you might have product, sometimes, these were warmer. I mean, you needed to build trust before you've actually returned capital, right? And then you had to start somewhere. So where did you come, when did you kind of figure out how you thought about pipeline and, getting introduced to somebody to actually saying, hey, like I want you in?
It's interesting you bring that up because I remember vividly at Preferred Tax Liens and even Employee Solutions raising capital in my early 20s. Like I would create the story, paint the picture, get excitement, and then just go away. And I would not ask for the money or the close. And then I remember like we started getting to some pickles at Employee Solutions and at Preferred Tax Liens. Like, where's the money? Like we can't do this if we don't have the money. And so it's like, okay, I need to start asking for the money. So I started figuring out, how do I do that? And one of the ways is I started to tell people that in the Preferred Tax Liens instance, my mentor at the time, Marv, was investing his own money, and he was behind the product and recommending it to his clients. And he was a very credible tax attorney in town, like probably one of the top tax attorneys in town. So that lent me credibility. So here's not this 21-year-old punk just having his hand out trying to raise money. Now Marv is sort of my mentor, sponsor, and an investor of mine. And it added and lended credibility.
Social proof.
Yeah. And this is way before the internet. So it's like, it's literally showing up with a book and like, here, read this book, that I'm giving you this private placement memorandum, and I'll, tell you about how I can make you money. And then eventually you built a track record, and it's easy. Once you have a track record, like, hey, I bought 100 properties and I returned all the capital for those 100 properties. I didn't foreclose on one. They're like, okay.
Yeah.
That's an easy sell.
Yeah. And you have a reputation. People are talking about you.
Right. But, reputation's everything. Reputation's everything. And I think if you went back to my first 40 investors at Preferred Tax Liens, I mean, half of them are probably dead, but I think the majority of them would say, yeah, I'd invest with Todd again. Didn't lose money. Good guy, maybe a little braggadocious and annoying at times, but I didn't lose money. So not a bad guy. So, if all those deals would have gone bad, I mean, I probably wouldn't be sitting here today doing what I'm doing. So,
right. And then how'd you translate into going into kind of venture and starting Canal Partners?
It just sort of happened, I think, just naturally by funding a bunch of companies. So after I sold my position in Employee Solutions, like I said, I seeded and co-founded NetTime Solutions, Raw Sushi, MD Labs, Monterey Pasta, which was a public company. So deal flow just started coming to me. This is back in the late 90s where there just wasn't a lot of capital in Phoenix. Yeah. Like if you could raise $2 million in Phoenix for a growth startup, you were like, I mean, you got to call that guy, that guy can get you $2 million. Like nobody was worth $20 million back in 97, 98, right. It's like, if you can raise $2 million, you were a hero in this town. And so I think I was one of the 20 people that people called when they wanted to pitch a growth equity investment. And it wasn't necessarily technology. There was mostly non-tech, but there was, like NetTime and a couple tech deals in there, but most of them were non-tech. So I think it was just sort of a smaller universe, smaller number of people to call. And they knew I was able to put money in. And I started syndicating early. It wasn't just like I wrote all the money. It was like, okay, Todd puts in $100,000 and he gets 4 of his friends to put in $400,000, and there's the $500,000 seed round.
It's so funny, like how the bare bone necessity, like we try to like complicate it, and you select this investor for this reason and that investor for that reason. But really at the end of the day, it's a supply and demand curve, and you could bring together capital, right? You were involved in formation of capital through a network here, and you supplied it to people that were looking for capital. And really that, I couldn't imagine what it was like in 2008, but in 2015, when I started in this business, was totally different. Yeah.
Well, the internet changed a lot because you can do a lot more research. You can find out about people. You can, back in pre-internet days, sort of pre-2000, it was like maybe you hired an attorney to do background checks and, ask for tax returns and things. But like nowadays you can really vet people a lot more than you can. I mean, just going to their LinkedIn and calling people, you can find out a lot about people. But back then it was like, it was a leap of faith. It was trust. And, you can get burned, you can get burned. I mean, I've been burned, plenty of times in my career by people. If a deal goes bad, fine. But if you get burned, I say that's on me, because I'm the one who's supposed to vet it and do the due diligence to make sure no one's stealing or doing anything that's unscrupulous or unethical.
And then, so deals going bad. Yeah, that happens. And then when you're in a syndicate function, which we both are, we're not in the fund business. How do you relay failure? Right. And because they don't have the diversification risk. And how do you go about doing that?
I hate it. I hate it. Even though they say bad news first, good news second, I'm still an optimist guy, half glass full. I mean, this thing could be on life support and I'll be like, there's still hope. We're still going to make money. It's
Dude,
like,
no one's more excited than they are now.
Yeah,
Everyone's pumped up.
It's like Eterus light posts. Like the thing's literally like the doctor's like, turn off the fucking machine.
Yeah, put a pillow over the head.
I mean, this thing ain't coming back. This guy's he's going, you know? And I'm like, no, we're going to do it. One more round, one more new CRO, one more product, and that's probably why I'm not a great operator, is because I am the ultimate sales guy in CRO that just wants to promote and high five each other and like, let's get excited. But when you have other people's money, you got to be a little bit more careful. It's your own money, do whatever the hell you want. But when you have other people's money, I think you got to keep them informed of what's happening. Like, look, this thing's probably 9 out of 10 not going to make it. But if it does make it, that 1 out of 10, this capital is going to get paid very well on it. I think just honesty and transparency. And people appreciate that. I mean, I invest in a lot of different funds. I don't want the guy that's going to give me all the great news and never give me bad news,
So there was a blog article I read recently where they looked at all the transcripts from Warren Buffett's annual investor meeting, which is, a hallmark event every single year. Everyone goes. There is nobody who's got a better brand than Warren Buffett. And they found that the amount of times that he says that I've been mistaken is infinite, right? There's thousands and thousands and thousands of references. And no one looks at him as being dumb.
Right. Right. They appreciate that and respect it. And he's humble. Like, I mean, the guy who's not humble, who says he's never lost money in a deal, don't walk, run from that guy.
Yeah,
run.
That guy is a full of shit.
And I've heard that from real estate guys and guys in the early, seed world are like, oh yeah, I very rarely use money or I never lose money. I'm like, okay, that guy's first of all, he's a liar. So you should run.
Right. And, it breeds trust. Right. It breeds a level of humility because guess what? Everyone's had failure in their life at some point and can relate to it. Right. And have been humbled. But you've had some success that wasn't humbling, especially in the beginning of Canal Partners. Right. You've had some hallmark wins. So tell me what that was like.
It was a lot of fun. I mean, when Jim and I were there before you got there at Canal Partners, I mean, first of all, we were like the only game in town. It was like, maybe a couple angel groups and a couple high net worth individuals. But as far as a real, like a firm, there wasn't really Greyhawk was sort of upmarket a little bit. There wasn't a lot of competition. So I think when we got a look at a good deal, it was like, we got it, whether it was PT or, in that time or, any deal that was like a pretty decent deal. Like didn't have a lot of competition. Where now, if you have like $1 million or $2 million of ARR and you're got phenomenal KPIs.
You could be in Yuma, by the way.
Yeah, you could be in Yuma. You're going to get found.
Right.
Like people are going to find you. Back then, people didn't find them. And I remember like Jim and I negotiating with the Web PT deal and we're like, no, we need a participating preferred. They're like, oh, okay, $3 million pre-money, 2.5 times ARR. And they're like, all right. I mean, today you like laugh at those terms, right?
Right.
But at the time, that was the market.
Right.
Like there wasn't a market to understand what's traditional. So we had a lot of success and did a lot of great deals. I think looking back, we probably should have shut down and closed some deals earlier than being the eternal optimist. Because I think Jim and I maybe had this God complex where we thought we can turn everything around and things would just turn around. But looking back, it's like know when to fold them, like that old Kenny Rogers song. Like sometimes you just got to know when to fold them and preserve capital and not throw, good money after bad. Yeah. That would be my lesson is like the 4 or 5 deals that went under probably could have saved that second or third round by just not going back in and saying, you know what, this one's just it's not a runner. It's not going to work. Because I find the ones that work, it's like, it's beautiful. It's like so art. Yeah. I mean, you're at board meetings and you're like, wow, this is amazing. They just crushed it. You don't even want to offer advice because they're just doing so well. But the ones that don't do well, it's like you're constantly trying to like figure out and fix all these issues.
So do you believe in power law?
And what?
Power law, essentially that there's one deal to outlive every other one of the deals. The typical venture capital model where, you know, you have one that's the winner that makes the fund.
I mean, that's not my model, but, you know, I've probably done 26 deals in my career. Somewhere between 25 and 30 is probably my guess. And I definitely had plenty of failures, but, I haven't had a 100x or, you know, 50x. I think the largest multiple was like WebPT and it was still under 20x. So not necessarily, you know, the typical venture model in that sense, but these days I'm looking for preservation of capital. So like I'm looking at a deal now where we probably spend 20% of our time discussing this deal on the downside. Like if this thing does blow up, they can't raise more capital. We have to liquidate it. Can we get our $1 million back? And we discuss that. Most VCs aren't discussing that,
right?
You know, so I'm discussing that. How does it look if it blows up? We got to fire the CEO. We shut it down. What can we sell? What's the value here? Almost like a turnaround guy. You know, I mean, yeah, there's plenty of upside. There's no doubt we can make 30 times our money in this deal. But
there's a lower probability of that.
Yeah, it does, if it blows up, how do we get our $1 million back? It's almost like the stage fund guys and all these turnaround guys. I start thinking like that, as well as the growth equity guys. So I'm like, it's a hybrid now is where I'm kind of at in my life, it sounds like. So
yeah, I seem to always veer towards the downside,
which is good. I mean, you know, if you're losers or you're getting half your money back, that's a win. Like most VCs are like not going to spend the time or energy.
Getting your money back in a hard time is like, I mean, I like that more than I get 5X. Right. I mean, that's just like, do you know how hard I work to get this fucking money back?
It's hard. Right. Yeah. When a deal does not go well, getting your money back is very difficult. And if you even get 50% of your money back, it's like, it's a win.
Yeah.
You know?
And generally it's because of your effort as a board member.
Right.
Right. As opposed to the other way where like you really don't do shit. And
well, most VCs, if it doesn't work, just write it off, move on.
Right.
Like they're not going to spend time on that.
Right. You know, and I think it's funny because I don't know if I think spending the time on it is one thing. What I've learned also is that the mentality is you can only lose one time your money, but like your reputation matters. And so generally when things go sideways or go down, friction happens with the founder.
Right. Typically, yeah.
You know, and they're always looking out for their reputation with founders. And, you know, all it takes is one founder to say, oh, he's a shitty, you know, VC, you know, he told me what to do, you know, he, you know, told me to cut my salary or to fire this person. And founders listen to other founders more than they listen to investors. So I've noticed that kind of happen too. They kind of been like, oh yeah, well, do what you want to do, you know, but you know, they know it's going to be a zero or they know that it's going to be not a huge outcome for them, but they just don't want to rock the boat too much.
Yeah. I don't think Canal Partners, you know, worried about that too much.
No.
So, you know,
we were a bloody chainsaw.
It's like, we're going to, you know, Chainsaw Al, you know, the old mythical CEO that used to or Hacksaw Al or whatever they called him. But, you know, Jim had that attitude like, hey, if this is not our guy, we're getting rid of him. And it doesn't matter how we're getting rid of him. And I agree with that. Like you can't, once you stop believing in a CEO and stop believing in his ability, and especially on ethics and morals, like you have to do that yesterday, not today. And there's no like treading nicely and being nice. It's like, no, we got our money in this business. This guy needs to leave yesterday, period. It's like an abusive relationship. Like get to a shelter, like don't stay in it.
But the problem with that is if you're willing to do that, you are essentially taking ownership of the cap table.
No question.
Yeah. And you have to be willing to do that. And, you know, like underwriting the business at that given time.
Yeah.
Because founder equity, this is why venture capital works, right? Is that the founders are incredibly incentivized to work hard, right? And
for way below market salary.
For way before market salary, they give a shit more than anybody else. And we've had our experience in bringing in hired guns.
Yeah, and it's just not the same.
It's a disaster.
It's a disaster. Usually.
Usually.
Yeah. There's every once in a while you hire somebody, you know, we've had some of those too where it's worked out great.
Sure.
You know, but most hired guns, it's a paycheck.
Yeah.
And a cush job typically because we're not all over them. You know?
Right. And, you know, we hired them because they were the expert and, you know,
And they don't give you the bad news first. They give you the good news first, and then they give you the good news second.
Right.
Yeah. And it's like, wait, where's the bad news? Oh, everything's going great.
Right.
Oh, by the way, we need another couple $1,000,000.
Yeah.
It's like, oh, okay.
I can't work like this. I need leaders.
Right.
Yeah.
Yeah. So it is hard to turn the ship for sure on founders. I do agree with that. We have a couple situations now where I think the founders are phenomenal founders, but they're maybe not the right CEO at 5 million of ARR.
Totally. Yeah.
And it's like, how do you have that conversation when they don't want to leave? Like they're so in the seat and they love it, but it's maybe not their skill set at 5. Maybe it was at 0.
Totally.
And it's like, but you got to have the conversation if you feel it, if that's what you believe.
No, totally. It's funny. It's, people always talk about founder friendly and, I just call it sometimes business stupid, right? And there's a thing about founder incentive that it's not that you want to oppose them because it's their baby and it's the wrong thing to do and they put so much irk, then you're not a good partner. It's the fact is that like you just get more juice from them, period.
Right.
And listen, man, I don't want to fucking bankroll. I mean, these companies have way too much risk, right? For you to be the bankroll, and we've been in situations where it's totally not worked and we made situations that we made money and did good at, right? So there's not a right or wrong answer to that, I don't think.
But you can't become emotionally attached. That's the key.
Totally.
And I think we became emotionally attached where we felt like we owned it. It's our kid. We're responsible for that.
Totally.
It's our baby. And looking back, I would say you can't do that.
Yeah.
You have to be unemotional, unattached, and look at it objectively.
Mm-hmm. No, exactly. And then when you're trying to get in these hired guns, they're just not like no one good is going to come work for a shitty startup, right? I mean, no real person is going to do that. We got lucky, you know what I mean? In one occasion, I think, maybe more in your career, but,
no, it's true. It's, you're betting on the founder. I mean, I say it's the founder first, it's the idea and the business second, and, like in my current portfolio, my best company in my portfolio is a founder that if he wasn't there, I'd be like, I'm like scared shitless. Like, I wouldn't be sleeping. But just knowing he's the founder and CEO and he's in the seat and he thinks about he called me last night, 2 nights ago at 9 p.m. my time. He's in New York. That's midnight. And he goes, I'm just leaving the office. I could hear him like going to the subway. I mean, what hired gun's going to be at the office till midnight? No. And he's making 20% of what he can make in the market.
Right.
I mean, you can't replace that, you know?
And especially these middle-aged guys, there really is an opportunity cost because they're getting great benefits. They could be housing money away. And you're only going to live so long. I mean, if you're young, who gives a fuck, right? Sometimes you'll get paid more at a startup by getting funded than you would normally, at a job. Yeah.
So there's a lot to be said with keeping that founder in as long as possible. But when you just can't keep him in anymore, whether it's ethics, morals, just a terrible CEO, I mean, you got to make a move. I mean, you're doing your investors a disservice. Otherwise, it's the spray and pray model. You're just like, hey, I'm going to throw a bunch of money out and hope it works. You're not literally doing anything.
Yeah, no, I think that's right. So in the meantime, we've had some time, and then David Paul comes in, we do some deals, we turn around one of the companies, we shut down 2 companies, I believe, at that time. And then Jim, our partner, decides to retire, right? And you went off and started Brookstone. So tell me about Brookstone. How's it alike? How is it different than Canal Partners?
Pretty similar, except I really do miss David Paul on my team. You brought a sense of professionalism and intelligence and due diligence and a perspective to Canal that I definitely miss at Brookstone for sure. So I kind of feel like we're riding a little without a saddle at times at Brookstone, but it's a similar model. It's sort of 1 to 3 million of early stage capital. Typically it was SaaS, but now in the last couple of years, it's not necessarily SaaS. It could be tech enabled. It could be services. I mean, we put $1 million in a company called Wing that is a virtual assistant company. So that's not something we probably would have done at Canal. So, it's a little bit more than what we did at Canal. I mean, we're opening the boundaries. So we're not just on SaaS. Where
It's
can we
like
make money?
It's kind of like where you first started your business.
Yeah, exactly.
It's all growth capital.
Yeah, it's growth capital, and it's not necessarily SaaS or just software. It's, I mean, we're looking at a pickleball company now, putting in $1 million in a pickleball company. Nothing to do with, tech. So we are starting to look at non-tech deals, but I won't do consumer product deals. We have one consumer product deal in our company that actually is doing okay, but like, I just can't, it just gives me too much anxiety.
Totally.
It's like they need money every single day. And it's like, I just can't, can't,
I know.
So service companies, tech enabled, potentially a high margin product company. But again, it comes down to the founders, the structure, the organization, what's working, like looking at this and like, hey, they got to $1 million in revenue with no capital. How can we replicate this? Or are they going to screw it up when they get capital? They're going to hire all these middle management people that are going to do nothing and just balloon the expenses.
Right. So I've heard of this pickleball. It's pretty fun, right?
I'm addicted. I'm addicted. Yeah. I literally could play every day. I could play every day. It's so much fun.
So what's in the future for you?
So I'm 56. I turned 56 a couple days ago. And my partner is 62. My other partner is 45, but going on 70. And, everyone's semi-retired. So it's like, we don't need to work 8 to 5 every day. We work smartly. So when there's an opportunity and we think it's appropriate, we will go forward and fund a deal. But we're not looking at deals all day. We're not trying to stay busy. We're just trying to be opportunistic. And right now there's 5 companies in the portfolio, and I don't ever see us getting beyond 6 or 7. If one sells, maybe we'll do another one. But, it's sort of a lifestyle business, like a small family office lifestyle business that I love. And I'm trying to bring my son into the business now.
Awesome.
And he's a senior at ASU. So he's going to board meetings. He was at the Blue Tail board meeting today, and he's learning. So I would love for him to come into it. And really, it's about managing money. Where's the opportunity? If the stock market crashes 30%, you shouldn't be talking to me about investing in early stage SaaS. You should be talking to me where do we put money in the stock market now? What GARP companies in the stock market are trading at a fraction of their true value, historic value. So it's all opportunistic. Where do we put money? It's like Soros says, I don't care where I'm putting money. I'm putting money for risk capital. And he bet the farm on silver and made a fortune. He bet, so it's like, where's the opportunity? And there's some things I won't touch. I don't care where crypto goes, high or low. It's just something I'm not capable of assessing. But I can look at public companies, and you and I have talked about some public companies that are really trading at historically low valuations. And if you have a 3 to 5 year time horizon, I think you're going to make a lot of money, where you can give me $1 million to put into an early stage SaaS, but the risk profile is completely different than buying, some of the companies we've discussed.
But it's not sexy.
It's not sexy, and you don't have the control, and I don't get the fees. And,
There's a lot of stuff you don't like. Yeah.
Right. But, I always look at where would I put my own money? If I can't put my own money in my own deals, I shouldn't be asking my friends and family for their money.
If it's not a full body yes, right?
Yeah. And most VCs have less than 1% of the partnership, right? I mean, their GP is 1%. Unless you're really wealthy. And I can't ask my friends to put money in if I got 25 grand in the deal, we're raising 2 million, but I'm putting 25,000 in.
Yeah.
It's just not fair.
Totally. And I feel like I've missed out on a lot of opportunities because they didn't fit my box. How do you think about biases? Right? Wanting to sit on board. You've changed your biases, right? In Canal, we had to sit on boards. We had to have price rounds.
We had a lead.
We had a lead.
We had to run the documents.
Yeah. How do you think about that now with Brookstone?
I'm a lot more relaxed.
Yeah.
I do like that model. I am on 1, 2, 3 boards, and I might be going on a 4th because one of the other board members is going on paternity leave. So I might go on a 4th, but it's not necessary. Like that wing assistant. I'm on a board. I have a very good relationship with the founders. I talk to them every week. We go to dinner once a month, and I get financials. The only issue is if you have a real problem with the business or founders, there's not as much as you can do if you're not on the board or leading the round or the majority of the series, right? So it does matter if you need to remove the CEO or change up the founders. That's where it really matters.
Or like, accepting a large amount of capital where it prevents you from getting out, right? I feel like that is something that can happen, right? If you take on too much money and, taking a real deep look, and it could be a great valuation, but this business isn't worth that.
Well, that's funny you mentioned that, because I just got out of a board meeting, and the last half hour of the board meeting, we discussed raising capital. And then one of the other board members goes, well, hold on. Before we discuss raising capital, what do we think we can possibly sell this business for? Like, let's use a middle to stretch case, and then let's discount that to a current round. And even though we can get a good valuation today, are we just screwing ourselves?
Yeah.
Like, okay, we feel good. We got a great valuation, but now we can never sell the business unless it really grows.
Right.
So I don't think a lot of boards think about it like that. And which is really fascinating, because how are you going to get out and raise a new fund if you can't get out of these deals? Right. And you're seeing that now. Like, all these last funds are like in tons of deals and they're not getting out of them. Mm-hmm. They're like stuck. Yeah. Because the valuations aren't there.
Yeah, I think that happens a lot in vertical SaaS. Like, you invest in a couple $1,000,000, but you don't get to that point where you can take secondary, and it's like, fuck, like, how do I get an A done? Can I get a small A done? Can we just convince some schmucks to put on a note? You know what I mean?
Well, that's why, when you, Jim, and I had Canal, I loved that. Maybe it was our motto or our tagline, but like, we are conservative capital. Like, we are not your typical VC. Like, we want the founders to own the majority of the business upon an exit. Yeah. We don't want you to continue to raise money. We want you to give a little bit of growth capital, hit the gas, try to get it 5, 6, 7, 8x your current revenue, and then let's get some liquidity.
Yeah, and we want to buy some of your stock if you need money. Right. Like, that's
and let's run this, slight loss, break even, but not let's not start burning $500,000 a month and hope it all works out.
Totally.
So I liked our model, and it was different. I think it's becoming more common today, but it was definitely different at the time.
Safe notes versus priced equity.
No, I hate safe notes. They should be illegal. Yeah. The SEC should make them illegal. I've been so screwed on safe notes. Yeah. And luckily I had good founders that made it right, but boy, they could have screwed me. Yeah. I think I'm smart. I thought I was smart. And I'm like doing these safe notes going, 12 million pre. And then when they do the A round, it's like, wait a minute, that 12 million pre is now 18 million. Like, wait, how'd that happen? Right. So I didn't think of all the potential, situations, but I really won't do a safe. And if you force me to do one, it's definitely a post-money safe for sure, without taking any risk. Right. Because I'm not doing pre-money safes anymore, but even do a priced equity. I mean, if you're doing $500,000 or less, maybe do a safe. But if you're doing like a $1 million round, do a priced round. Yeah.
No, exactly. Especially if you're putting in $1 million, right? I think that deserves a little bit more respect.
Yeah. And you got no rights. Like, you have a safe. You don't even have an instrument. Like, you have a future promise to, you don't have any rights.
I was saying, like, there's a deal we're in now, and it's like the safe holders, like, it doesn't even convert. There's not like a pref, like, if it converts before, like, if you have to sell it before it goes.
Yeah. Like, what do you really have?
You have nothing. You just get your money back, no interest, no principal, not like a preferred, like, anything.
Yeah. So you're with me on the safe? Like,
I'm with you on the safe.
Yeah. No more safes.
Yeah. No more safes. I did a convertible once, and it didn't turn out too bad. So I just stepped out for a bathroom break. This is very reminiscent.
How'd it go, by the way? I used to say, like, no one goes to the bathroom more than me, and then I met you. And I'm like, between the two of us, I honestly think we're doing like 30 flushes a day in the Canal office.
Yeah. It's bad.
30 flushes a day. Yeah. By the way, how great was that office? The old Fred Unger office.
I know.
I mean, that was...
Which one? The one on the third floor?
The last one that we were in. I mean, how amazing is that office?
That was great.
That was a great office.
Did we get out of that lease? Like, how did we
do it? We did. He had someone, and then apparently they didn't move in, so we got lucky. But yeah, we got out.
Yeah, I mean, we had like a 5-year lease on that thing.
It was not cheap.
No, it was like $10,000 a month, wasn't it?
It was expensive. Yeah. Beautiful office. Those socials are great on those patios, and
I miss the office, the original office.
Yeah, we're next to where you are now.
Yeah, next to where I am now. I always had a dream of taking that office back over one day.
It was a cool office. I mean, with the kitchen, and I mean, originally it was a model for a townhome back in 2000 when they were building these brownstones around here, and they just, with the crash, they never built them. So they just kept that office. But that was like the model for the brownstones, you know, and it was a great office. The big screen, the big war room in the middle. Yeah.
Geo-focused funds. Arizona, not light on capital anymore.
No, there's a lot of local funds that have a lot of capital.
So what do you think?
I think it's great for the founders, entrepreneurs. You know, I mean, if you got a business, either pre-revenue or even in revenue, and you got a good team and a good product, good business, like you're going to get funded, you know, which, you know, brings up a whole nother question. Like if you can't get funded here and you've talked to everyone, like, do you have the right business, you know? But there's a lot of capital. I mean, hundreds of millions of dollars focused on Arizona now, hundreds of millions, you know, pre-revenue and early revenue. Not sure how it's going to turn out for the LPs. We'll see. Do
you think Arizona deserves this amount of capital?
I think it's a lot of capital for Arizona.
Yeah.
I think it's a lot of capital to digest.
That capital hasn't been returned.
Right.
Or like that capital.
It's new capital.
Yeah, that capital was not made in tech, right?
It's new capital. And I think time will tell. But it's going to be really, really interesting to see how the returns are for this. I think for them to make it work and have decent returns, they got to pile in a lot of money into the winners. So like when they know they have something that's going to 20 million of ARR, like a Virtuous or, you know, something that Paradox that's like, that's like certainly on its way to 20 million, like they got to stuff as much money as possible in there and get in deep. Because if they spray and pray and do 50 companies, I mean, it's not going to work. If they do 15, 20 companies and like go in deep on the winners, like and just figure out how to get more money in, I think they'll be okay.
Okay. Ready for this?
Yeah.
Lightning round. Postmortems. Tranual. Should have done it.
Yeah. Should have done it. But you know, churning 8% a month, it's hard to get your arms around
They weren't that bad.
In the beginning, they were turning the whole book over every year.
Oh yeah, well yeah.
The first 2 million in revenue.
I remember. Actually, I do remember in Tall Wave their churn was high. And we're like, nonprofit, right?
Are you talking about Trainable or Virtuous?
Sorry, Virtuous.
Okay.
No, yeah, Tranual always had kind of a higher churn.
Yeah, no, I was talking about Tranual.
We're gonna get fucking crucified for this podcast. By the way.
No, Virtuous was a mess.
It, I'm moving.
Yeah, Virtuous was a mess. I mean, we should have done it. Gabe's a phenomenal founder.
Yeah,
we should have done it.
We offered him like 4 times.
Yeah, we gave him a term sheet, and we got blown out of the water. But that one, we made a go at it and didn't get it. You know.
Yeah. Trainwheel, we had a look, right? And we sent a term sheet, or Virtuous we did. Yeah. Virtuous. Trainwheel, we never actually did it. You know, we never tried because the churn was pretty high. I don't know if since then it's been corrected or not. What's some other ones? Full Bay.
Full Bay, we gave him I think we gave him a good term sheet. I think we were just under 20 million. It's like, you can't go much more than that for a $4 million business. For us, you know, and they got like double our valuation. Right?
That was a small TAM. Yeah. That was a small TAM with like, and their like gross churn was higher.
Yeah.
Right.
And not a very big team, like a very thin team.
Yeah. Which we loved.
Yeah.
I mean, he burnt hardly anything.
Yeah. He was very conservative.
He was a good guy. I could have backed that guy.
Yeah. I mean, we obviously would have made money there, I think, but actually I don't even know. I don't know how they're doing now, but you know, that was one that we gave again, we were playing in valuations from 5 years before when we were issuing the term sheet. So like we were, you know, 5 years, our predecessor on valuations, and we weren't at the times, but you can't always be at the times. Like if you miss, you miss. It's fine.
Yeah.
Like
we saw it.
Paradox. Never could have got that deal.
We had an opportunity.
I know, but it
was you and me, and we took that pitch.
I just couldn't get my arms around
the guy was
the
an
founders.
asshole. Yeah.
I mean, there's no way. There's no way.
Yeah. I mean, like we would have gotten fucked somehow.
Yeah.
Yeah. You know,
well, it's like
on the note,
the virtual, what the hell's the name of the company? Proctoria.
Right.
The virtual, proctoring. Same thing. Like we had to look at it. We actually I think we had a signed term sheet.
We did. We had something.
A signed term sheet, and it's like we just didn't get that deal done. But again, when you don't have a...
Did we pay like $20,000 in legal or something?
I think we did.
Like something like insane.
We had a signed term sheet. We had docs.
We negotiated to buy the founder stock, and the founder would not even talk. The excommunicated founder wouldn't even talk to the CEO. We did him a
brokered the deal.
favor. Yeah.
We brokered the deal.
We made it available for him to buy that stock.
Right. And I was like, you know what? He's a mensch. He's going to do the right thing and just throw us 5% of the company for doing that. I'm still waiting for the stocks.
Yeah. I still like that. I think he eats I think he eats at your restaurant.
All the time. And I think one time he says, I'm giving you 5%. I'm still waiting for the stock certificate.
Yeah.
But I brokered a deal where those two were never talking to each other the rest of their lives, and
Teddy. That was his name.
Teddy. Yeah.
Teddy. You were negotiating with Teddy.
I was on the phone with those guys all the time. How about the one in Chicago that we didn't get done in the restaurant space?
Charlie.
Yeah.
Yeah.
Did that turn out okay?
It's like 10 to 12 million now, but but they're on the SMB side and they're churning pretty hard. You know what I mean? And it's a lot of things. I mean, this is the one lesson is that if it's not, at least $1,000 a month of, ARPU of software spend, like it's going to get pulled out. You know what I mean? Like you need to have something that's good enough where people are going to spend real money on it.
Right. Yeah.
What else?
So what are you going to do? Are you going to focus more on the Southern California market? Or are you going to still stay Arizona, Southern Cal?
Some news. So now that Todd mentioned it, I am moving to San Diego from Phoenix. And yes, I'm still going to cover Phoenix. I've always been kind of a San Diego. I've always still covered it, but I think that got kind of a little frothy too, but I think it's going to come back down.
Do you think valuations are lower in Arizona than Southern Cal? Mm-hmm. Yeah. Even with all the capital here?
Yeah. It's funny. I think there's more institutional seed capital here now, but they've been slow to deploy. Right. So, like Scoresby just officially finished and, there's a lot.
When he finished, like raised his fund?
Yeah.
$25 million fund?
Correct. Yeah. And so like before that, he was doing like one-offs, right? And so now he's got a cadence, right, that he has to do.
And AV, VCs, 100 plus.
100 plus. Yeah. AZVC and AVC. They didn't talk to each other before they branded.
Yeah. Right.
And yeah, no, so I'm looking, but it's funny. It's just like you said, platforms matter to the point solutions now. Mm-hmm. You got to find something with really good ACV or else it's really hard to make money. And, people don't really want to buy SaaS anymore. You really have to have a really unique offering.
Do you feel pressured to get a deal done if 6 months go by, a year go by, and you're like, I haven't got a deal done. Do you start to break your mold of what you're looking for just because you feel emotionally you have to get a deal done?
100%. Yeah. At least I don't necessarily break it, but I start to break it in my head. Right. And
this is okay. Oh, this, you start to make it excuses.
Right. Or the deal kind of is shitty, but the valuation's good. You know what I mean? Like it's growing, but the sector sucks. Whatever it is, it's like, I still haven't done a deal in a year. Right. And but then it's like, part of me is just like, if you did have a fund, I feel like this is not, you can't index, right? But I also feel like even if you do all the work, right, and you do sometimes things just don't work out, and it's hard to catch that in diligence. Yeah. There is a level of luck in this business. But this has been fun. Yeah, thanks. I lost my bet to my wife, so I appreciate that. And happy birthday, by the way. Thank you. Happy big birthday. Big 39. You got one more year in your 30s. Yeah. Enjoy it. Going to have a blowout on the 40. Yep. Awesome. Thank you, everybody, for listening. If you like it, please subscribe, tell a friend. We drop an episode every Tuesday. And cancel me. Do something to bring me down, because I've got a big attention need insecurity problem. So just attack me. Do something. Just notice me. Stir it up. Yeah. Stir it up. Anyway, thank you so much, and I'll talk to you next week. Thanks. Bye-bye. Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital.
This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.